Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. In today's segment, we're exploring the mortgage outlook for 2025. According to recent reports, Canadians can look forward to potentially lower mortgage rates and more attractive deals next year. This anticipated trend is driven by several economic factors that could play a significant role in shaping the real estate market in the coming year. The Bank of Canada has indicated that they might adjust interest rates as part of their monetary policy strategy to support economic growth. This adjustment could lead to decreased borrowing costs, making it more affordable for prospective homeowners to secure a mortgage. Additionally, the global economic environment, including potential easing in inflation pressures, might contribute to a favorable climate for lower rates. Economists, including those from major financial institutions, suggest that as the economy stabilizes, lenders may become more competitive, offering better rates and incentives to attract borrowers. This competition among lenders could result in more options and flexibility for Canadians looking to enter the housing market or refinance their existing mortgages. However, it's important to approach these predictions with cautious optimism. While the outlook seems promising for lower rates, external factors such as geopolitical tensions or unexpected economic downturns could impact these projections. Therefore, staying informed and consulting with mortgage professionals can help navigate these potential changes effectively. As we move into 2025, it's crucial for potential buyers and current homeowners to keep an eye on these developments. By understanding the trends and preparing accordingly, Canadians can make strategic decisions that align with their financial goals and housing needs. In our next segment, we're diving into the current state of Canadian household debt, which, according to the latest data from Statistics Canada, has been outpacing the country's gross domestic product. As we approach the end of 2024, it's evident that Canadians are borrowing more aggressively, thanks in part to lower interest rates and certain moral hazards. This trend raises questions, especially as some of the fundamental economic indicators are showing signs of weakness. The total outstanding household debt in Canada reached a staggering $3.01 trillion in October, marking a 0.3% increase, which translates to an additional $10.3 billion from the previous month. Compared to last year, this represents a 3.7% increase, the fastest annual growth rate since June 2023. Even when adjusted for inflation, household debt is climbing at a rate faster than the GDP, highlighting a potentially concerning economic imbalance. Breaking it down further, mortgage borrowing accounts for a significant portion of this household debt. In October, household mortgage debt surged by 0.4%, or $8.2 billion, bringing the total to $2.24 trillion. This growth outpaced the overall increase in household debt and marked the highest annual growth since September 2023. The Bank of Canada's decision to cut rates has played a role in reigniting mortgage credit growth, as it has improved consumer sentiment and contributed to a recovery in home sales. On the consumer credit side, the story is similar, with non-mortgage credit experiencing robust growth. The balance of consumer credit increased by 0.3%. Adding $2 billion and pushing the total to $776 billion in October. This represents a 3.9% annual growth rate, the fastest since February 2023. Experts attribute this rise in consumer credit to the increasing cost of living, as households turn to credit to manage their expenses. Additionally, there has been an uptick in credit card delinquencies and insolvency filings, indicating financial stress among consumers. Interestingly, while mortgage delinquencies are on the rise, they haven't reached the levels many had feared. This is largely due to the stringent measures that Canadian lenders have been encouraged to adopt to mitigate potential losses. However, this approach has sparked a debate about moral hazard as some argue that it might encourage risky borrowing behavior. The implications of rising household debt are multifaceted. On one hand, lower rates can stimulate the economy by allowing consumers to bring forward their future demand. On the other hand, rising credit demand amidst a slowing GDP and increasing unemployment could signal mismatched economic incentives. It's crucial for policymakers and consumers alike to navigate these dynamics carefully to avoid potential pitfalls. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.